Good morning. I'm Tim Nyland, and today we are reintroducing the ECP Core Equity Portfolio Tilt Strategy Framework. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. This is the fifth and final webinar in the new 2021 ECP Family Series. You can see on the screen I have all the 4 prior webinars highlighted or circled in red, and these are available on our channel. If you'd like to do the kind of analysis you're going to see in this video, you're going to need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor Tools and the Zacks Research System. Today, I'll be using Zacks Advisor Tools to showcase some new reporting capabilities, and I'll be using the Zacks Research System with composites to look at the variability, valuation, and profitability trends related to the S&P 500, the actual ECP Core Equity Portfolio Composite, as well as the earnings certain Core 75 stock portfolio. Let's go ahead and get started. To simplify things, let's go ahead and talk about what most actively managed equity portfolios have in common. And traditionally speaking, they have a core. And this is the main equity allocation component. And the idea here is that this portion of the portfolio should provide protection in down markets and should still offer participation in up markets. And over the course of the past 3 weeks and the prior 3 webinars, I've shown the portfolio statistics related to the 3 core portfolios that are part of the earnings certain family, and that's the Core 75, the Admiral Core 30, and the Dividend Aristocrat Core 25. Each of these portfolios represent core and provide that downside protection and still allow you to participate in the up markets. The next part is the macro tilt portion, and this is a longer term tilt, and this is going to allow for more upside capture through exposure to higher beta. And traditionally speaking, these are going to provide additional exposure to the growth sectors. In this case, we're talking about the benchmark, the S&P 500, so we'll refer to the S&P 500 in that regard. So the idea here is that you can also use ETFs, but for the ECP strategies, we do recommend that you use the earnings certain portfolio 6-stock tilt. And we'll talk more about that here, obviously, in a few minutes. But the sectors that represent that 6-stock tilt portfolio are key, and those are the information technology sectors, communication services sector, and the consumer discretionary sector. And we'll talk a little bit more about how all this comes into play shortly. The tactical tilts are going to be your shorter term tilt that are going to allow you to gain upside capture in various economic cycles. So these are going to consist of the economically sensitive sectors, and obviously the securities and ETFs are going to be the best way to gain exposure to these sectors. Again, financials, energies, real estate, business cycle sensitive industrials, metals, and commodities names are going to be your tactical tilt type names you're going to be looking at. So the idea here with the macro tilts, you might be asking yourself, why only 6 stocks for the long term? And the idea is we have to know our benchmarks. So if you look closely at the S&P 500, you'll see that there are massive biases contained in the S&P 500. In the spreadsheet that I have below, I've actually taken this out of a webinar that I did over a year ago, specifically, I believe around April 24th of 2020. You'll see the date here in the spreadsheet. And keep in mind that when we did this webinar last year, the market cap of the top 5 stocks in the S&P 500 equaled the bottom 355 stocks in total market cap. By Q3 of 2020, the top 5 stocks peaked, making up about 24% of the S&P in terms of its actual market cap weight. If you go back to 2012, and even prior to 2012, when we started having the big rotation away from the energy majors into the technology as far as your leadership groups in the S&P 500, for those that were managing money back in the day, you can remember when Apple overtook ExxonMobil and others to become the #1 stock in the S&P 500. These 5 stocks have since transformed the characteristics of the S&P 500 and have delivered the bulk of the returns over that time. During COVID, these top 5 names were some of the most resilient names during the COVID crash. These 6 names also have many, many underlying ECP qualities that we've discussed over the last several weeks. And we utilize a total of 6 macro tilts. So it's the top 5 names that I have circled here plus Adobe Systems. So when we update this spreadsheet now as of last Friday, we'll see that even after this big rotation to value that we've had in 2021, the top 5 S&P holdings still make up 21% of the weight of the S&P 500. That the combined market cap has increased 3 trillion or 60% from 424. You'll see that we are now at about 8 trillion across the top 5. If we go back to the previous slide, you'll see that was about 5.1 trillion, 5.2. Okay, so we're up roughly 60%. It's now equal to the bottom 342 names in total market cap. So really not much has changed. We've literally gone from 24% to roughly 21%. Used to be 355 names. We're still the top 342 names. And that's with an increase in market cap of roughly 3 trillion. So it's a massive, massive bias that is built into the S&P 500 that you have to be aware of, obviously, when allocating assets. So the idea here is that if you invest $100 in the S&P 500, $21 of it right now would be allocated into a top 5 holding. So out of that, roughly $5.42 would go into Apple, $4.87 into Microsoft, $4.23 into Amazon, $4.14 into Google, $2.43 into Facebook. And you can see that the sectors related to those names here: information technology, consumer discretionary, communication services. These are the sectors we have to pay close attention to. These sectors in and of themselves represent a massive weight in the S&P 500, let alone these 5 names comprising a whopping 21.09%. So again, it's the top 5 S&P 500 names plus Adobe. These inherently define the ECP Macro Tilt for a total of those 6 stocks. Should come as no surprise. If you're not allocated to those 6 names, when those 6 names happen to break out, as we've experienced in the past, your returns can suffer dramatically. So let's consider the S&P 500 sector allocation for a minute. Down here is a portfolio report, a sector breakdown diversification report out of our Zacks Advisor Tools platform. And I have circled in green at the bottom the primary macro tilt sectors. So consumer discretionary, information technology, communication services. Again, those are where Amazon reside, Google, Facebook, Microsoft, Apple, and Adobe. And you can see that those sectors represent 51.8% of the S&P 500. The sectors in red, these are the tactical tilt sectors that we do not hold in core. And these primary tactical tilt sectors only represent 15.6% of the S&P 500. We've heard a lot about these sectors year to date. Their performance has been absolutely staggering, these 3 primary tactical tilt sectors. But when you combine their performance with the relatively low weight in the S&P 500, the contribution to the S&P 500 really is not that dramatic. So if you consider, again, the combined weight of these 3 sectors representing 15.6% of the weight, and you consider that energy is up almost a whopping 50% year to date, and when you consider that it only has a 2.6% weight in the S&P 500, you're looking at about a 1.24% contribution year to date to the S&P 500 return. It's not a whole lot. Although there's a lot of talk about these sectors, it's really not a lot of contribution. Financial is going to be probably your largest. It's clocking in at about 29.5% return year to date. It has a larger weight, obviously 10.6. It's contributing a little bit over 3% year to date to the S&P. But real estate, coming in at almost 24%, really small weight of 2.4, sitting at about 57 basis points worth of contribution to the S&P 500. Okay, so it's very, very easy to get distracted with these primary tilt sectors. They do not represent near the weight as the macro tilt sectors do. So just be aware of these biases in the S&P 500. So how do we apply these macro tilts to the ECP strategy? Again, we've reviewed this over the past several weeks. We're going to do this a little bit differently this time. So again, bring that information technology, communication services, and consumer discretionary sectors equal to the S&P 500 weights. And you can see down here that we did this with the ECP Core 75. We applied roughly a 30% macro tilt. You can see that consumer discretionary comes in with a little bit of an overweight. Infotech is still a little bit underweighted, so we've got some room there to potentially apply a shorter term tactical tilt, perhaps with semiconductors, perhaps with something else to bring that information technology weight back up. And communication services, obviously just a slight overweight here. But the idea here with the tactical tilts, we want to address the remaining economic cycle sensitive sectors with those shorter term tactical tilts. So anything highlighted in red, now is where we would want to go in and make those allocations into energy, financials, and real estate. So why would we want to do this now? Well, again, let's recall some of the allocation scenarios that I've been proposing over the past 3 webinars when we were looking at the core portfolios. Remember that we have 3 sample allocations depending upon where we're at in the economic cycle. So we can either be preparing for a recession, we could be either in recovery stage coming out of a recession, or we could be where we're at right now, circled in red, which is where we're getting ready to go into our normalized earnings growth phase of the economic cycle. Remember, that's the phase where the S&P earnings begin to level out and begin to come back down to trend over the past 25 years, which is roughly 7%. We will look at the growth of the S&P 500 forecast EPS here in just a minute, but if you recall from prior webinars, we are looking at F1 growth of roughly 35 to 40%, and then we're going to taper back down to about 11% for FY2 and FY3. So we are preparing now to get into that normalized earnings growth phase. So if we're going to use the ECP Core 75 stock portfolio as an example, we would want a roughly 50% allocation to that. Macro long-term core tilt about 30, tactical short-term economic cycle tilt around 20%. So how would this actually look? The equity portfolio value of, let's say you had $1 million, could be allocated as about $500,000, again, 50% divided by the 75 stocks. So it's literally just an equal dollar allocation, $6,667 per stock. You've got a macro long-term core tilt. It's literally 30% of that million, or 300,000, divided by 6 stocks. It's literally $50,000 invested in each stock. Tactical short-term economic cycle tilt, we've got a lot of different options here. I just chose a very simplistic case, $200,000 allocated across energy, financials, and real estate. We could have ramped up our tech weight by 5% or so by allocating a certain portion of that to a semiconductor ETF as a tactical short-term economic cycle tilt. But in this example, we're just keeping it simple and sticking with energies, financials, and real estate. Okay, there are a ton of other tactical short-term economic cycle tilts that we could use, right? We've got metals and mining stocks. Again, with the reflation trade, with the economic recovery, all of these stocks, all of these tides are going to rise at the same time. Commodity and basic material stocks, or ETFs. Again, utilize the Zacks ETF rank, utilize the Zacks stock rank. We're going to be breaking down for the ETFs that award-winning Zacks rank at the individual equity level, and then rolling that back up to the ETF level. It's a phenomenal tool that you have access to with Advisor Tools and the research system. Industrial stocks that are sensitive to the economic cycle as well. Some great names, right? The Caterpillars, the Deeres of the world, AGCO, you name it. Semiconductor stocks we just talked about, use the ETFs for additional tech weight as well. small cap stocks, mid cap stocks, and even some thematic plays out there. In the past, we've talked about 5G. We've talked about not only the 5G super cycle, but all the technology that goes along with that. I maintain a list of those stocks. You can certainly email me. I'd be more than happy to send that over to you. But those thematic names, that growth play again will come back into favor. Right now, there's a really strong value rotation underway, but the growth theme will come back into favor at some point. So the idea now that we want to explore is, why do these 6 macro tilt stocks continue to perform? Recall that these macro tilt names have been our tilts roughly since 2012. And in order to illustrate why these names continue to perform, I want to go back a little bit and refresh everyone's memory here on the price and earnings chart out of the research system for the earnings certain portfolio. This is the core 75 stock portfolio. And I want everybody to remember how stable that trailing 4 quarters operating earnings line is here in orange relative to the price, and how stable that price line is. And you can see that we've got nice solid growth, no spikes, no massive dips, 8%, 15 for FY1, 8% for FY2, 13% for FY3. Keep in mind, as we're coming out of a recession, these numbers are going to change quite dramatically from week to week. They are subject to change, and there might be some variability, as some of that growth has certainly been pulled forward to 2021, and then we're gonna normalize back out come FY2, FY3. So normally these numbers are a lot tighter, but given how we're just coming out of a recession, this is very normal. You'll see these numbers get exacerbated for the S&P 500. You'll see that 35% for F1 normalizing down to 11% for FY2, 11% for FY3. Keep in mind the long-term trend, right? We discussed this in the prior 3 weeks webinars. For S&P 500, earnings growth is roughly 7% annually. So these numbers will still normalize out down to around 7% over time as average. So now we take a look at a composite of the 6 earnings certain portfolio macro tilt stocks as a composite. And right away, you'll see that the earnings growth is literally 2 times that of either the S&P or the actual core portfolio of the earnings certain 75 stock. And you can see that here, F1 growth at 41%, F2 still at 16%. Now we're actually accelerating for F3 all the way up to 27%. And you can see those characteristics, that earnings certain quality, just rock solid stability in earnings. And then we get a nice ramp up here in EPS. A lot of this obviously being driven not only by Apple, but Adobe and Microsoft at the same time switching to that subscription model for their enterprise software, really putting an accelerator on the earnings line here. And then obviously this group just absolutely just crushing it during COVID. Interesting thing I want everyone to notice is that these companies have literally been sitting flat now for almost 9 months. We're going on an extended period of time where these things do tend to sit flat and then they'll break out. And so we're getting to that point, and the reason why is that as this happens, you've still got this underlying growth that just continues to deliver on the bottom line. So we're still growing earnings at 41%, 16%, 27%, all the while the price is sitting flat. So we call this a valuation catch-up. And what it's doing is it's actually compressing the forward PE multiple. And we're going to see this here in just a few minutes. We're going to look at another slide. But this is what I really want you to pay attention to, is that we've got value that's just continuing to be built with these 6 names as this price continues to just sit more or less flat for the last 9 months. So this is a really, really good thing for us on a relative value basis, because we all know what's going on with the S&P 500 and its PE. So we'll look at that here in just a minute. So again, just to show you why the 6 stock tilt portfolio for the earnings certain family on the macro side is so successful. We've talked about this before for each of the core portfolios. It's really important to look at this for your tilts in isolation. So this is, again, a composite of the 6 stocks in the Zacks Research System, the earnings certain tilts portfolio here, versus the S&P 500 market weighted composite. And you can see that these companies collectively, their ability to compound return on total assets, which is very difficult to do, is literally 4.5 times more effective or efficient than the average stock in the S&P 500. And if you look at the ramp up here in this group of stocks, you can see it's significant. And it's I looked at obviously all of the individual names. They're all doing this just tremendous job of delivering return on the asset base. And you can see in the bottom panel here, I've got Apple versus Caterpillar. So put Caterpillar in here as one of those names that's been talked about a lot. I mean, it's obviously had a tremendous run. It's obviously a recovery name, not only a domestic recovery name, but a global recovery name. And its ROA just is nowhere near as impressive as an Apple. Apple is literally crushing it by a factor of 4, and we're not hearing anything about Apple these days, but you will. Just some additional examples, right? Microsoft versus a John Deere. We hear a lot about the likes of Deere. We still hear things obviously about Microsoft, but if you look at the metrics here, the ability to compound return on total assets, there's just no comparison. Microsoft is literally 3x that of John Deere. And nobody really has anything good to say about Facebook. They can say all they want when you're compounding return on total assets at 5 times the rate of GM, and everyone's excited about GM. Just keep in mind these metrics matter. Okay. When we start taking a look at the ability to compound return on common equity, this is where things get really interesting. The earnings certain tilt portfolio just absolutely going parabolic in 2020, 2021. You can see that we're literally 2x the average of the S&P 500 in terms of the average member of the S&P 500. And when we take a look at the ROE of Apple versus a stock like Bank of America, you can see, why this metric has just been driven through the roof. Apple clocking in at 111, Bank of America coming in at about 9% return on equity. Okay. So when we take into account the debt structure, this is ROC. Remember, compounding return on total capital gets more difficult. All the numbers tend to come down unless there's obviously no debt on the balance sheet. The earnings certain tilt portfolio relative to the S&P 500, you're looking at about a 3x, about 2.5 times actually, more effective or more efficient at compounding return on total capital than the average name in the S&P 500. Bottom panel down here, Amazon versus John Deere. Again, 2 popular names, 2 companies that are always talked about these days. And Amazon is coming in at about 2x over John Deere. Again, compounding return on total capital. Another popular metric I love to look at, free cash flow return on invested capital. This is literally just comes down to these companies' ability to generate cash. The earnings certain tilts portfolio, looking at about a 3x difference between that and the average company in the S&P 500. So really, again, not just a 1 or 2 year anomaly here, but this has just been the way it's been, for 20 years. And take a look at a company like Alphabet. I just put Berkshire Hathaway up here. Again, I just grabbed companies at random. When I think free cash flow, I always think Warren Buffett. Berkshire Hathaway is obviously just a phenomenal company. But when you stack them up in terms of their ability to compound free cash flow, return on investment, you take a look at a company like Google, it's just incredible. Google's sitting at about 3.5 times more efficient than Berkshire Hathaway. So it's pretty remarkable what these 6 companies can do. When we look at the earnings certain macro 6 stock tilt in terms of its valuation, on the screen I've got the Zacks Research System forward 12-month PE ratio chart. This is a 20-year chart. And what I want everybody to notice is the fact that it always trades at a premium to the S&P 500, and you're paying a premium, obviously, for not only the growth, but the quality of the cash flows, the quality of the balance sheet, and obviously just the quality of the names in general. So it's always traded at a premium. What I want everyone to really pay attention to is this collapse in the PE ratio. Now, we've already talked about that. But keep in mind, this is a forward 12-month PE. So I warned everyone ahead of time that the fact that the price has been sitting flat for 9 months and earnings have been growing to the tune of roughly 40 to 20%, so 41% for F1, 20% or so for F2, this PE multiple has just literally contracted. And you can see that the S&P 500 PE multiple is basically still staying afloat. What I want everybody to pay attention to is the current points relative to the 20-year median. That right now we are literally trading at the 20-year median for the tilts, which is a really, really good thing when we talk about measures of central tendency, right? So we know we're not necessarily overpaying. We're getting it at roughly the average it's been over the past 20 years. Now, the interesting thing is that that's not the case for the S&P 500. As a matter of fact, we're paying as much for the S&P 500 as we did back here in 01 and 02, which is obviously a lot more concerning than what we're paying for the actual tilts. So what does this actually look like? Again, I wanted to bring this price and earnings chart back into the frame so we could talk about it again. That PE collapse is being driven by the fact that this composite group of 6 names has literally just been sitting flat. I mean, Amazon was trading around $3,200 a share back in September. I think it's still around $3,200 today. Same thing with Apple. It split, and it really has gone nowhere after the split. But these companies continue to compound this earnings growth that's just absolutely spectacular. So as this takes place every day, every week that goes by, that F12M earnings point just keeps growing and growing and growing. So we get this, what we call a valuation catch-up, where the earnings catch up to the actual price. And that is what is driving that PE ratio down. Okay, again, this is a really, really good thing in terms of relative valuation. And you'll see that in the next chart, you can see that the valuations for this composite of these 6 macro tilts for ECP is literally the cheapest it's been in 10 years. And it's getting to pretty much the lows of the financial crisis. So here's our current point here. You can see it as a 1.6. The low was a 1.43. And you can see where we peaked back here, and it's just been, this is obviously relative to the S&P 500. S&P 500 has been able to sustain its PE ratio, and the ECP Tilt portfolio has just gotten cheaper because those earnings have again outpaced the increase in price. The price has basically just been more or less flat. So again, super important to understand the biases built in. The idea here is, how to become a client. The Earning Certain family of portfolios are available in the Zacks Advisor Tools platform. We have several different subscription levels with various add-ons. The Earning Certain family of portfolios can literally be included in any of them. Just talk to your account manager or your sales representative. In the Zacks Research System, the Earning Certain family of portfolios is included. And the Zacks Research System is now being bundled with the ZAT Portfolio Manager proposition, so you get basically both platforms. We also have an ECP Premium support level that's now available for an additional fee. Again, this is for anyone that wants to use ECP as their own methodology. They want a premium level of service that would get them access to me and my team. We can talk about ECP methodologies. We can talk stocks, talk valuations. We can look at style analysis. We can help with marketing materials, strategy, any of the tilts, whatever you need. So that's an option. Be sure to join me next week. This pretty much wraps up our 5-part ECP 2021 relaunch webinar series. Next week, we will resume our normal strategy webinars. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or if you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you for watching, and I'll talk to you all next week.